Hello, and welcome to the Three Questions Podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. Now, if you or someone close to you are wondering whether fixed income can offer real returns again, or how private assets can enhance your portfolio without introducing unnecessary risks in 2026, stay tuned. Our topic: the three questions high net worth cross-border investors should ask about fixed income and private asset investing in 2026. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions Podcast, please consider liking this video and subscribing to our podcast and YouTube channels. Joining me once again on the Three Questions Podcast is Steve Cowley. He is the Chief Investment Officer here at One Capital Management, and Steve is also the Chairman of One Capital's Investment Committee. Steve is a Chartered Financial Analyst, and he's also a member of the Los Angeles Society of Financial Analysts. And today we're going to explore the three questions high net worth cross-border investors should ask about fixed income and private asset investing in 2026. Mr. Cowley, once again, we have you back on the podcast. It's great seeing you. Thank you for making time for us. First time in 2026, by the way.
Right.
But not the last. But not the last.
No, it won't be. And it's always great to see you. Always great being part of your podcast and sharing some of our insights with you, with your audience, with clients and all that. So thanks for having me again.
Great having you, Steve. So today's episode is the first of a two-part series, so back to back, so this week and next week. And we're going to be focusing on investing in 2026. Next week is going to be fully dedicated to investing in the stock market, in equities in 2026. No doubt you're not going to want to miss that episode. Steve, looking back at how things unfolded last year in 2025, what stood out or, as they say, raised a Spockian eyebrow? Was it the three interest rate cuts by the Fed, total about 75 basis points? Was it, and that brought the federal funds rate into the 3.5 to 3.75% range? Or was it that the 10-year Treasury seemed to be range bound between 4% and 4.2%, and then that went on for months on end? Or is it that the 1 and 3 month interest rates have remained higher than the 2-year rates? Or is there something else that kind of drew your attention, or any of the above?
I would say something else that drew our attention, and it wasn't necessarily on the fixed income side of things, but it was just how well the markets on the average and on the whole reacted to all of the noise that was 2025. And because there was so much turmoil, there's so much discussion around Trump and what Trump was doing and tariffs and all of those things. So really the biggest surprise was how well the markets did with all of that noise. Now, interestingly enough, the things that you mentioned on the fixed income side, none of that surprised us because that's actually what we were expecting all along. We expected the Fed to cut rates. In some of our earlier podcasts, you may remember that I said that the Fed funds rates are too high because, the way we look at it is on a fundamental basis that Fed funds should be around 50 basis points above inflation. Well, if inflation's running at 3, we're pretty close to where we should be.
25, right?
And yeah, now. Exactly. We needed to get down to that. So that didn't surprise us. The other thing that didn't surprise us is the 4-year, because one of the things we talked about is that the economy continued to do well. It wasn't overheating. It wasn't slacking off. And a 4% 10-year rate is probably about where we should be, given a 3% inflation rate. You want to have some real return over inflation. And it's not a level that will slow economic growth down. It's actually a level that's pretty conducive to a productive. So again, these are things that we expected. And then the other, the last part of it was that, it was the 1 to 3 years or higher than the
1 to 3 months.
1 to 3 months. Sorry, the 1 to 3 months were higher than the 2-year yields. And that's, again, it's a function of Fed funds and cutting Fed funds rates. And, now in 2026, we're about even with those two because we've cut rates enough to get us down to where those, because the 2-year was a forward looking. They were expecting, where's it going to be 2 years from now? Inflation's going to be, around that 2.5 to 3. Hopefully we get it down to 2 to 2.5. But even if it was at 3, that's you're looking out with the 2 year, and you're expecting cuts to happen within the next 2 years. And that's kind of how the market looked at it last year. So the 2 year number was reflecting kind of where we are today. The 3 month and 1 and 3 months were where Fed funds rates were. And so as they cut, those two numbers came together, which is kind of what you would expect. Ideally, you would have, again, I'm still arguing for a little bit lower Fed funds rates. Ideally, you'd have the 1 and 3 year treasuries lower than the 2 year, because the expectations are is we continue to grow, you get paid for that additional risk of taking 2 years. So again, none of that surprises. It's kind of what we've expected. We've been talking about here at One Capital for the last couple of years, that this is the scenario that's playing out. The scenario that didn't play out is that the Fed funds cuts were slower than I would have liked. Again, for none of the reasons that President Trump, and we've talked about this before, none of the reasons for President Trump, he just wants it lower because he wants it lower because he wants to stimulate the economy. That had nothing to do with it for us. For us, it's just pure fundamentals. Where's inflation? Where should Fed funds be in a stable environment where you're not trying to slow it down because it's too fast, or you're not trying to stimulate it because it's too slow, which is where we've been for the last couple of years. Fed funds rate should be about 50 basis points over inflation. And we're pretty close to that right now. If we can get inflation down a little bit to 2.5, hopefully Fed funds rates come down to 3, and we get kind of that normal rate. But again, as long as the economy doesn't overheat or it doesn't slow down, that's a normal relationship, and that's what we've been seeing, and I've been asking for a couple of years. Powell hasn't accommodated me, and he hasn't accommodated President Trump either. So.
You're not on speed dial, clearly.
No.
Unfortunately. Well, Steve, this podcast reaches listeners across the United States and Canada, and likely outside North America as well, including hopefully a good number of my clients and One Capital clients. I guess before we just move on to our questions, I think one of the biggest challenges that, we're going to probably talk about this a bit more. The biggest challenge, and we were talking about this a little earlier, is the influence that everyday ordinary investors are, the impact that the media, social media, has on behavior of investors and on how they react to news. Because if you listen, for example, the information that the American investor is receiving about world events, I believe, is different than what Canadians are receiving. And therefore, as a portfolio manager, we're managing money for clients in both countries. And, some of our clients in the United States have Canadian dollar accounts. Some of our clients in Canada have US dollar accounts. We're managing money for both, and they're getting information that's, and quite frankly, not the same, depending on where and how they consume their information. And I just wonder, from your standpoint as a portfolio manager, what encouragement would you have? And I know we're going to talk about this a bit more, but just before we get started here, what would you say to the folks that are, I guess the question I remember telling you this before, the first question first securities course I ever took, the instructor, asked the groom, what is the most important and first question a client will ever ask about your investment recommendations? And after this big long pause, because everybody was petrified of this particular individual, she answered, how safe is my money? So in the environment that we're in today, which there seems to be, once again, that uncertainty, how would you respond to anyone who's concerned about how safe their money is in today's environment? Whether we're talking about fixed income or whatever the case may be.
Exactly. And you kind of twisted that a little bit from your early statement, and then you said how safe my money. So I'm going to actually answer this in kind of a little bit of a two-part way. One, how safe is my money? It's very safe in the sense of, from an investor standpoint, we have custodians that hold the assets. We have, there's a division between, so there's a lot of safety in the sense that the money's going to be there. Now, what you're asking is, how safe is it relative to what's happening in the market?
Market volatility.
Volatility and all of that stuff.
Exactly.
And that's where I'm going to answer that question kind of in the second part of that, which is kind of how you framed it first. We're getting information from different sources. And I thought your question was going to be, what would be your advice to them versus is my money safe? And my advice to people is have skepticism. always have skepticism of everything. And especially in the social media age, you need to have a huge, healthy dose of skepticism of what you see and what you hear and what you read, because it's so easily to be manipulated. And we're going to talk a little bit about AI probably on this podcast, but especially on the next podcast when we talk about equities. It's so easy now to use AI to manipulate things and to make things look real that aren't. And we all see that. We see that in their social media, things like that. The other thing is as you said, especially contrasting the Canadian media with the U.S. media, and how I mean, there's a real nationalist feel in Canada, and rightfully so. I've said this, for a while, that when you say we're going to make Canada the 51st state down here,
Ooh.
you want to talk about
As a
nationalist.
Canadian, I can tell you that rattles
Absolutely. And it
pots
should
and
be.
pans in a meaningful way.
Exactly. And as it should be. That's where that nationalist pride, where you come together and so that now you're getting it through a lens that has you've now tainted because of that, because of that nationalistic pride. And like I said, that's what it should be. If somebody attacks the United States, the Americans should be doing the same thing, and they do. And again, think of now. I'm going to throw one wrinkle. Think about what the people in Europe are hearing, especially right now with Greenland and some of the other things. I mean, you're talking about the same news getting interpreted multiple different ways, depending
100%.
on where you are, depending how it's being presented to you, and depending on the lens that they're looking at it. So that's why I say the skepticism and all of that is really important, because you've got to be skeptical of the narrative of the news, why they're saying it to you. And because remember, news is entertainment now. It used to be news, it's more
Yeah, it's
entertainment
true.
now. It's clickbait, it's all those things that get people to watch, to get their advertising, get their revenues up, like everything. So the skepticism is really important. And so um, and that's how we do it. So be skeptical. The money is safe, and things are not what they appear when you rely on social media, the media, or politicians. Again, everybody has an axe to grind, and they're all selling it their way. And so you've got to be careful, and you've got to look underneath that. And one of the things that I think we pride ourselves on is peeling off those layers and getting down to what's fundamentally underneath it all, and trying to react to as close to reality as we possibly can come by looking at data, not emotions.
So I guess it's so safe to say, I think we'll both agree that at this point, we're not looking out the window expecting the four horsemen of the apocalypse to come down over the hill
Not
anytime.
not yet.
I'm going to jump out on a limb here at my own peril and say that as a Canadian, to my friends in the United States, the idea of Canada as a 51st state, my comment on that would be careful what you wish for. And I'll leave it at that. Okay, Steve, it's time to get to our questions. The topic today are the three questions high net worth cross-border investors should ask about fixed income and private asset investing in 2026. Again, my good friend Steve Cowley, Chief Investment Officer here at One Capital Management, join us. So, Steve, let's get right to our questions. And without further ado, and we're going to get right to the point. Question number one: is fixed income investing finally attractive again, or is it still a defensive allocation? Mr. Cowley.
I'm going to give you the my standard two yes and yes. I usually say yes and no, and I talk about the two parts, but in this particular instance, I'm going to say yes and yes. Fixed income makes sense as a viable asset, and it's something that you want to invest in because something that you mentioned and we've talked about a little bit earlier is real returns. And a real return is a return greater than inflation, because you're not just eating up inflation. Back in 5 years ago when interest rates were 1.5%, and inflation was 2, there was no real return. Your real return was negative in that case, because you're actually losing money to inflation on your fixed income and investment. But we talked about this a few years back on one of your podcasts, that you still had it for the second part of your question. Is it a defensive
It was
play?
defense.
And it was purely a defensive play because it really mitigated the risk that happens with the equity markets and the swings that happen there. Today, the answer is, and actually for the last year and a half, 2 years, the answer has been yes and yes, because you're getting a real return on your money. And we usually look to treasuries, Canadian treasuries, U.S. treasuries, to look at that real return. Am I getting a return greater than inflation? But then when you start adding in a little bit of risk to your bond portfolio, which means adding provincials, adding municipals, adding corporates to the mix, adding some of the agencies here in the United States, you start adding incrementally to that return. Then you add some of the high yield that we've got, and we're going to talk a little bit about private assets in a minute. You add some of the private assets, and all of a sudden you're starting to get yields that are significantly better than inflation. So you're getting a real return on your money, and
You're
it's
getting
and
paid.
so
You're getting paid
you're
nice
getting
rent
paid
while you're getting a distribution.
exactly. But it doesn't take away the defensive posture that fixed income is, because the correlation between the two, and correlation is just how they act relative to one another. So you want a low correlated asset if you want diversification. You don't want them all, if it's perfectly correlated, they all move exactly the same, and
No, it
that's not what you want.
doesn't work.
Diversification is, you want them to act a little bit differently, and the lower the correlation between the two, the less they act alike. So bonds have a very low correlation to equities, with the exception, of course, of shocks. But everything becomes correlated when you have shocks to the system. But it's a low correlated asset. So when the equity market is having its volatilities, when there's concerns, when there's corrections and things like that, the fixed income is what kind of carries you through. The other thing is you get a chance to rebalance, because if you started with a 50-50 portfolio, equities drop, my fixed income usually didn't drop. So now my fixed income, 60% of the portfolio, equities is 40%. You take fixed income out, you buy equities, and you bring it back. It's the old buy low, sell high mentality, and it's a way to discipline to do that. So it's a very good defensive strategy. But the best part about it is we're now getting real returns. It makes a lot of sense to add fixed income portfolio, to get return off of your portfolio, to get cash flow, to get real return, and to smooth out the portfolio. So fixed income is a good place to continue to be right now, not for just the defensive, but for the income side of it as well.
So we have clients, as you know, in both countries. Again, we talked about this earlier, in both Canada and the States. We'll call them cross-border clients, cross-border families.
Yeah.
From your perspective, is there a sweet spot in terms of fixed income duration, especially for clients with assets that are split between not just two countries, but two currencies? So, as you know, we have clients that have, maybe they'll have a portion of their money is in a Canadian non-registered account. I can think of a couple right off the top of my head. And then they'll have their IRA accounts that are in US dollar investments in the US. So for folks like that, when you look at duration, is there a sweet spot right now? I know, remember back in 22, 23, you were talking about back then, the duration of the bond portfolio, I think it was like somewhere between 2.5 and 3 years or something. Like, it was really short term.
Because one
How
and a half
about
to
today?
so today we're around 5 to 5.5 in our duration. And just to
In both countries, in both Canada and United States?
in both countries right now, we're about the same. And so when we talk about duration, just kind of educationally as well, is duration is, you don't want the technical term, because the technical term is the weighted average cash flow to maturity. Throw that out the window. Duration is basically, it's how many years to maturity, and how does the cash flow affect that. So like if I have a 30-year bond, duration is actually less than 30 years, because you're getting cash all along the way. And the other thing is, it's a really good measure of volatility within the bond market. So it's another reason that we use duration versus maturity, is because it gives us a pretty good idea of what's going to happen. If interest rates go up, the duration is going to tell you the magnitude of your portfolio's movement. So if you have a 1 to 2 duration and interest rates go up 1%, you have a 1 to 2% drop in value in the portfolio. If you have a 5.5, which is where we are now, duration, and interest rates go up suddenly 1%, you're going to have a 5.5% drop in the value of the fixed income. Conversely, if rates go down, you're going to have a 5.5% increase. So we use duration because it's a good measure of the volatility in the portfolio. And it also kind of gives you an idea of how long the maturity is on this. So again, it's not a true maturity, but it helps you have both numbers and both things in your portfolio. How long is the average maturity, and how long is what's the volatility in the portfolio? Again, not pure duration is not exactly, that's a little bit different. But that's why we look at it, and that's why we extend it, because we've extended maturities. And the reason that we do that, and the reason you guys are the same in Canada and the US, and one of the things to find that sweet spot is you look at the what's called the yield curve. What is the difference between a 1 month treasury and a 30-year bond? And we'll use treasuries, Canadian or US treasuries as our proxy for that. And what happens with fixed income is the longer the maturity, the more risk you're taking of default, of things changing, especially with treasuries is not a risk of default, but there's risk of things changing, risk of inflation, risk of
Increased
recession,
interest
risk
rates.
of exactly risk of 100 different things. So you get paid more for the risk that you take. So the longer you go out, you get a little bit more interest rate. So that creates what's called a yield curve, and that's that steepness of where the yield curve goes. And so what you look for when you're talking about the sweet spot for duration or yield curve or anything else is you're looking for the steepest part of the yield curve before it starts flattening out. Because once you get out to 10 years or so, from 10 to 30, you're just not getting, it flattens out significantly. So you're not getting that much more interest for 30 years.
It's not worth the risk.
It's not worth the risk to take that. So when you're looking, you kind of look for the steepest spot, because I want the most yield possible, that I'm going to get the biggest bang as it goes down as it gets closer and closer to maturity. I'm going to get not only the highest interest rate, but I'm also going to get some possible appreciation if I sell that earlier. So you look for that sweet spot. You look for the steepest part of the yield curve. You look for that spot where it starts to bend back out and flatten out. And for the U.S. and Canada, they're pretty close to the same. And that number's, the duration size is around 5.5, and that's where the portfolios are on both of those. So there's a lot that goes into fixed income. It doesn't feel like it sometimes, because it's just, I'm going to buy a bond, it matures, I get interest rate on it. But there's a lot more to fixed income management and how you manage around that than most people think and most people give it credit. So that's where we are.
The big
We're
part
there,
of what the investment committee does at One Capital is trying to figure out what the
exactly.
duration and
Yeah, and
again,
going exactly, and going back in history, the reason that we were short back, 3 or 4 years ago, 2021,
there
2022,
was no ways to go
was
but up, Steve.
it's
I mean, his
it's
interest rates
well,
were almost zero.
exactly, rates were zero. But if you extended, which a lot of people did, to pick up that 0.5% or whatever, because they were desperate for yield, they took on significant risk to do
We
that.
saw that here in the
And we
state of
just said,
California with a particular bank, as I recall.
oh, exactly. So we just don't believe in taking. You get paid for what the risk you take. That's fundamental to investing. Don't force the issue. You get in more trouble forcing the issue than you do being patient and getting paid for the risk you're taking. So when inflation took off and interest rates took off, and then we had the where inflation then started coming back down, that's when we took that, the duration. That's when we took our maturities and we started extending them, because we started getting paid for the risk we were taking. And so we slowly moved it out from 2 to 5.5, taking it at 1 or 1.5 steps at a time. And right now that's where we are. It's working out really well for us. We had a very good year last year relative to the markets on our fixed income. Again,
I think we're pretty optimistic
get
that
paid
probably
for
we're going to see I'm going to go out on a limb here and say I would expect we're not going to see the Fed raising rates here in the next little while.
no.
It's
Exactly.
just a
So
hunch.
take advantage of the yield that you're getting, and again, it goes to the 10-year that we mentioned. I mentioned earlier in your pre is, as long as the economies are doing well, like, there should be a steepness that yield curve.
Did you imagine if the
And
new Fed chair Steve came in and raised?
ooh,
Ooh, yeah, I would be. I'm trying to. Yeah, that's an alternative universe.
yeah, that
Um,
would that would that was that would cause a little bit of consternation in the markets to begin.
the White House. Hello. So,
Exactly.
yeah, our topic today is the three questions high net worth cross-border investors should ask about fixed income and private asset investing in 2026. Our guest again is Steve Calley, Chief Investment Officer here at One Capital Management. And he's also the chairman of One Capital's Investment Committee. Again, Steve, thanks for making time for us. We're going to move on to question number 2. And here we go. What do private assets actually add to a portfolio, and what do they not solve? And I'll acknowledge that last week on our last episode, we had Kelsey Severud, Dr. Kelsey Severud with us, and we dedicated the entire episode to private assets. But I wanted to get you to chime in here just on that because I know it's we're increasing our exposure ever so slightly in private assets. So again, what do they add to a portfolio from your perspective as the chief investment officer here at One Capital Management, and what do they not solve? Take it away.
So what do they add to the portfolio is a couple of things. One of the things we talked about is diversification, and we talked about correlation and how they move relative to one another. Private assets are not, they're low correlated assets relative to equities, but they're even the correlation among fixed income is significantly different than a publicly traded fixed income. And one of the things that private assets, good or bad, is they don't have the same visibility or
Mark to market.
transparency
Mark to market, I think is the term we
through
use.
mark to market. So that's the transparency of the public markets is every day they're priced and they're priced every minute of every day. That's why you go into the bond market, you're seeing it and you see volatility. The private side of things is not mark to market, meaning it's not private. So there's a little less transparency that you don't see what the prices do every single day. And there's not a market to change those every single day and every single minute and every single hour. And so they don't move in the same direction. Now, again, good, bad, or indifferent, that's the way they work. And one of the things that I think, the professor you talked to last is sometimes that's not a bad thing because it takes emotion out of things. And sometimes again, when you're in the public markets and there's subject to emotion, we saw that yesterday and we saw that today with how the markets were down because of a possible Greenland, and everybody's worried about an actual invasion of Greenland. And today, and I'm putting a date on our podcast time, President Trump's at Davos. He says, "Oh, by the way, I could do that if I want, but I'm not going to.
Please
That's off
stand
the
by.
table."
Please stand by on.
Exactly, and we'll see what happens there. But so you see that emotion move the market significantly, and when the private place, because it's private space, because you don't have mark to market on a daily basis, and you don't have the emotions into that, they tend to be a little bit more stable over the long run because they don't have that. Now they do reprice on on a monthly, a quarterly, however they're pricing them in their systems. So if rates change, they will adjust prices, but they'll do it more on a logical and a price matrix type of thing versus an emotion and where people think things are going. So that's one of the advantages. And then you have higher yields, you have higher expected returns in the private space because again, risk reward, you get paid for the risk that you take. You're taking a little bit more risk because it is private, it's not public. There's a little bit less transparency, so there's a little bit more risk to it. So you're getting paid to take that risk to go with privates. And you're giving up some liquidity because in the public space, you can trade a bond. Like I said, that's why I say it, the price minute to minute is we can buy and sell a bond at any time that we want while the markets are open. With privates, you usually have a window of opportunity to take your money out. But, and so you give up
maybe
some
increments
liquidity.
of 5%. Well, I think the typical
Exactly.
is about 5% of the value of the fund per quarter, I think. So
Right. And
get
so you
in
get paid.
line, get in line early.
Exactly.
If
So,
you,
well, and even that won't matter because if more than 5% take it out, it's going to be on a pro rata basis. So,
yeah,
um,
fair enough.
but so the advantage is diversification, higher yields, higher returns, and we're talking fixed income here. I'll touch on the equity side of privates in a second, but those are the things that you're gaining. So you're getting better yield, you're getting better. Again, investing is a long-term game. It's not short-term. It's not gambling. It's not. So
Speculation.
you're exactly. You're looking out to the future, and you're saying, "Hey, I don't need to have my bonds mature today." I mean, that's when we talk about duration. That's why we extend our duration. And so if I can extend a little bit of duration, especially if I can pick up yield, I can give up a little liquidity because I want that cash flow coming in on a regular basis at a higher level than I would at some of the public spaces. And then where you say what doesn't it answer is liquidity is the biggest issue because you do give up liquidity. If something happens, you just have a little longer tail to maybe get out of it. Maybe it's a quarter, maybe it's 2 quarters, maybe it takes you a year to get the money out of private credit. Now, private equity, depending on the structure, it can be significantly longer than that, where you have to go to the secondary markets where you're forced to sell your interest at a severely discounted price just to get rid of it. So on the equity side, on the private credit side, which we're talking kind of fixed income mostly here, it's a very good enhanced asset to add to the portfolio. Not the whole portfolio, but as you said, we're adding it more and more to the portfolios. We're adding it as a piece of the fixed income. It's just like when you add high yield, you're adding risk, but you're adding return to that as well. This is just another one of those where you're adding a little bit of risk, but you're adding significantly more return in this case to get that return. And then of course it's the due diligence of the company that you're buying those private assets through. You want to make sure that you're at a reputable place. You're looking at we're using interval funds and we're using fund of funds so that we get a broad diversification in that. Wherever you go for the private credit space, just be aware of the risks that you're taking. And again, here at One Capital, we use a fund of funds. We use an interval, so we have a little more liquidity than some of the others. And you get instant diversification across lots of different assets within that private credit space. If you go direct to a private credit lender, and there's a lot of them out there, there's Ares and there's Apollo and you can buy individual. Just understand the risk you're taking when you do that and the lockup period, because sometimes it's a greater lockup period. So that's where the downside is you give up liquidity to get better return. And then the structure of it can also be a little bit of a, not an impediment, but you can have a little longer lockup period depending on what you get. So just be, again, it's one of the things that we do. It's one of the things that, at One Capital, but that's something that all investors should just pay attention. Just know the structure, know the risk, know the liquidity around private, because they're great assets to add to the portfolio. There's a lot of diversification and there's increased expected return. Just understand the risk that goes with it and the liquidity.
About a year ago, I guess it was in the last year, we got into a situation where now we're able to allow Canadian residents to invest in our U.S. private asset strategy. Do you see any additional diversification benefits as a result for Canadians? I mean, would you like to just chime in quickly for the Canadian clients that are listening in now that we are adding, private assets to their portfolios? It may be a similar. I don't know if you want to comment on that.
It's very similar. The private asset space is just significantly larger in the United States. So by able, and the structure that we're doing and getting those investments in the Canadian portfolios, the beauty of it is, again, not a pitch for us, but by doing it, we've got a hedged version. So if you're a Canadian investor, there's a version that will, hedge it back to Canadian dollar, so you take the dollar risk out of it. And then there's another, sleeve that is unhedged, so you're taking the U.S. dollar risk as well. But the advantage of that is you're getting into a marketplace, and you probably talked about this last week, and we talked about it a while ago on one of our podcasts, that in the private space, especially the equity side of things, about 70% of the companies out there that make 100 million or more in sales are actually private. They're not in the public space. So there's a whole vast marketplace that you can't get to.
87%, I think the last I checked, Steve, 87% the last time I saw.
There you go.
87% of the companies that generate $100 million of annual revenue or higher are privately held businesses in the United States. That's incredible. And
so
Dr. Severud mentioned last week that just as a follow-up to that comment is that the number of companies going public is shrinking. So more companies are staying private for much longer.
Yeah. And we could have a whole episode on that.
Boy,
you had last week. But
stay tuned.
The advantage is you're getting into some small, highly profitable, fast-growing companies that you wouldn't have access to in the public market. So the private market in the private place, again, both on credit, because again, these same companies, they either don't have access to the banks or they don't have access to the public markets. And so the private space is filling the void. And get into a long discussion as to why, but regulatory changes in banking in both Canada and the United States has made it harder for banks to fund some of these private companies that have more risk than a well-established Fortune 500 company or a a TSX company in Canada. And so they're forced to go someplace else to find the money, and there's lots of private money that's available to them. And so it's just a function of how banking has changed, how regulations have changed. It's a great space to be in because it adds to diversification, it adds to returns, and it adds a very valuable asset to the that we haven't really had a lot of access to in the past, and it's becoming more and more accessible and more transparent. So, like I said, we're really happy with what's happening there. So,
yeah.
on the private side, like there's a lot of positives, and the negatives, are being offset because again, get paid for what the risk you take, and you're getting paid for that risk. It doesn't mean it's perfect. It doesn't mean there won't be times where you have a little bit of disruption, but that happens in the public markets. I mean, look back at March, April of last year, when we all thought, with the Independence Day or whatever the heck he called the tariff day, and the markets didn't like it much, and we had big significant pullback in the markets, and then we realized that it wasn't going to have the impact that it did. Markets came roaring back. Same thing happens in private markets as well, and not to that extent. Again, because you don't have the mark to market, you don't see the volatility as much as you do in those places. So, good asset class to add in a very profitable space. Again, know the risk, know what you're buying into. All of those things are really important when you add private assets to your portfolio.
Okay, Steve, thanks. Let's get right to question number 3 on the podcast here. And it's kind of a continuation of our conversation, but I think it should be focused on a little bit here. Is question number 3 is, how should investors think about liquidity when it comes to combining publicly traded fixed income and private credit investments? So just maybe a couple minutes on just to sort of wrap up, because I know we talked about it a little bit earlier.
Yeah. And one of the things I said is that you add it, as incremental to it. It's a part of the portfolio. It's not the whole portfolio. Where people, and again, this is a mistake that investors make. It's a mistake that advisors make, especially those that are, I'll use the word greedy a little bit. They're looking for that. They're pushing returns. I go back to 2000, 18, 19, 20, when people were pushing their durations out to get a 0.5% yield because they didn't think they were getting it. And it caused them problems when we had the, inflation kick in and all of that stuff. So it shouldn't be the whole portfolio. And what happens is when you're looking at private credit and it's, you're getting an 8%, 9%, or even a 10%.
Very attractive and very intriguing, right?
Exactly. And so it's like, well, I want all my money to be earning 10%. And so you
exactly.
put too much of it into private credit in that case, and now that liquidity really can come back to bite you, because what happens? You have an issue, a health issue, you have anything, and you say, oh, I need to get some of that money, and it's tied up. It's a little bit harder to get to. So it's a great piece of the assets. And then going to your question about, especially if they're concerned about the markets and pullbacks and corrections, again, if I've got all my money in private and the equity markets pull back and I want to reallocate money to it, I got to wait till the end of the quarter. I got to wait till, it's somewhere between 3 months and 6 months to get that money out so that I can rebalance. Well, you may have lost a lot of that opportunity. So you want
your opportunity, you lose. It's a lost opportunity is what it is.
It can be a huge, so private makes a ton of sense as the right percentage of it. You always want to have that public because you want the flexibility of the public, and you want that flexibility of rapid access to that money that you give up with the private space. So it should be a portion, and it should be an appropriate portion for what you're doing. If you've got if I'm young, I've got no health issues, and I'm running this thing out, and I've got a great job and excess income and all of that, I can have a little higher proportion because I'm not going to have those needs. As I get older, I'm going to just want to make sure that I'm managing my cash flow and my cash needs and my emergency needs a little bit better. So again, you'd never want to have you're overweight in that, but you're going to have a little bit of difference based on individuals' circumstances. But you definitely want to have that public money because that's where your most flexibility. That's where you can get it the fastest. It's really that's that defensive that we talked about. That defensive piece is really important. So you're getting cash flow, but that defensive piece is so important, and you get the defensive piece mostly from the public side, more so than you do the private side.
for clients that are concerned, Steve, about market corrections, right? Like they're we say a little bit more conservative, a bit more defensive. How much of a portfolio should remain in in liquid publicly traded fixed income investors versus private credit? Like to you, like if we take a look at just the fixed income portion of the portfolio, what would you, for a conservative investor, what do you think would be you could do it the other way around. Like how much should be
Yeah.
exposed to private credit investments versus, publicly traded fixed income? What do you think is the ratio?
Yeah, I think the max that you would ever really want to have in that in private space would be 30%
Ooh,
of your
that's
fixed
a
income.
very
That
high
would
net.
be that would be the absolute max. And again, because I'm talking about different, for most people, it's going to be that 10 to 20% because you're getting a good enhancement to your return and you're not tying up so
And
much
that's just
money.
on the fixed income side I'm
That's
referring
just
to.
on the fixed income side, exactly. So 10 to 20% of your fixed income in private is probably the right sweet spot. Again, young, circumstances allowed, you could push it up to 30%. Not what we would normally recommend. But certain circumstances, certain people, you have a client that's got $100 million, they have a little more flexibility than a client that's got $1 million in their portfolios and what they can do.
Um, if you look across both United States and Canada, the Canadian, US and Canadian markets, is there an overarching trend, in your opinion, in fixed income or private assets that you think could be a game changer for our clients' portfolios this year? Do you see something on the horizon that we should be thinking about?
The answer is no. In a sense, I don't see it, I don't expect it. But I will give you a couple of scenarios where they could change that. We just don't see it, we don't expect it. The fundamentals aren't showing it. But where we could see um, the game changer, the change, or something where we would react to what's happening would be um, a significant slowdown in the economy. Now, again, interestingly enough, if you had a significant slowdown in the economy, the Fed and after the people would be pushing rates down,
Hmm.
we might actually extend our maturities and duration in that scenario. Or the economy just heats up so much that all of a sudden it's growing too fast, and the central banks have to start tweaking it and actually start raising rates to slow things down. In that case, you'd go the opposite way and you'd pull your duration back down and you start bringing it back um, lower instead of longer. Both of those are low probability scenarios, but those are really the only ones that would significantly shock us. Now,
Significant slowdown or a significant
significant
bubbling up.
acceleration.
So a lot of people are
I
talking, Steve, about the potential at the beginning of, well, this year, once the tax refunds come out, that we could see what would I call be like an economic sugar rush,
Yeah,
where people are going to have higher than usual income tax refunds, and the assumption is that a good portion of that money will be actually spent on discretionary spending as opposed to fixed spending. I'm wondering actually if some of that money that may be used to pay down debt. And if that were the case, we would not see the inflationary
right.
any. I know when we talked about this in the past, the expectation was, you know, bigger tax refunds equals more spending. Given the fact that I think it's pretty well acknowledged that, the amount of debt people are carrying is now more than it was, say, a couple of years ago. Any update on your thoughts on this? And what were all this extra money from tax returns is it going to go? Is it going to go into the economy or is it going to go to pay down debt? Any thoughts?
I'm going to say it's going to, like everything, it's going to be some in both. um, with the concern about the economy, and again, this is what we talked about media and social media and all that. There's enough concern about the economy and affordability, inflation, all of those things that it very well could be, put into savings or pay down debt or strengthening up what we're calling strengthening up their balance sheet by
Hmm.
using that money in an appropriate way to just kind of build a little bit more cushion for tough times ahead. My personal opinion is that's probably not a bad thing. That'd be a great thing to do. Unfortunately, there'll also be some that just it's free money and they go spend it. I mean, that's just human nature. So there'll be a little bit of both. I think that it'll lean more towards cleaning up balance sheets and being a little bit less stimulative than some people might think or might have talked about earlier. But those things, and again, I'm going to even throw in Greenland and the disruption of Greenland or the disruption of Venezuela or the disruption. Those are usually events. Those are not trends, and those are not changes. And so there also you just have to be careful. So people like us, we love things like that, not from the event. I'm not saying that, but we love the opportunity that it provides when people react and overreact to something that's not a fundamental change. It's just an emotional change. Give me emotions, and I'm going to give you opportunities. Fundamentals will make the changes. Emotions, we take the opportunity. So.
Yeah, emotions destroys intellect, Steve. That's my experience.
Yeah.
So just before we wrap up here, and as a bit of a teaser for next week, we're going to have you back next week. We're going to be shifting the conversation to, the stock market and equities. Any high-level thoughts on how fixed income and private investment strategies complement or will complement equity investing next year, or this year, pardon me, 2026?
I think we touched on a little bit with the real returns. Fixed income, unlike 2-3 years ago, where it was almost strictly defensive because you weren't getting paid for the risk you're taking. So we had short duration, we're getting a lot of yield. It's a real complement because you're getting real returns and you're getting cash flow, which helps you with cash flow needs. It helps with spending. It helps with all of those things. So it's a real complement right now, even more so than it's been. It's been a number of years. Again, since we've had real rates of return that pay us to take the risk. It's a great addition to building a portfolio because you're getting real returns off of it, and you're getting the defensive characteristics. Right now, fixed income as part of a balanced portfolio is the way we used to talk about fixed income in a balanced portfolio. It's a great addition to the equities because it gives you cushion. It gives you cash flow and cushion against what's happening on the bigger macro picture in the investment world. And it gives you time to let equities come back from a disruption. If we had a recession, we come out of recessions and things get better and things pick up, and you're getting real returns off your fixed income. So you don't have to sell equities at an inopportune time. So right now, fixed income is again, it's back to the old ways we used to think about fixed income. It's a great addition to the portfolio from real return and defensive posture, and it gives you more the ability to weather the storm greater than even 2 years, 3 years, 4 years ago.
I think that 2020 is the old days. I find very disturbing, Steve. COVID. Anyway, I want to thank you for making time for me today. It's great seeing you again. Steve Colley is the Chief Investment Officer here at One Capital Management, and he's also the Chairman of One Capital Investment Committee. Steve, thank you. And we'll see you next week. We're going to have you back, and we're going to be talking about investing in equities in 2026. So we'll see you then. Thanks, Steve.
All right. Sounds good. Thanks for having me, and we'll see you next week.
Yep. I look forward to bringing you the Three Questions podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive a notification when our latest episode has been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we'll see you soon.